Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey, and my guest today is CoinFlipCanada of everyone's new favorite darling DEX, GMX. But first, a quick shout out to centralized exchange GMX'er. Use my code in the show notes and get up to $4,100 bonus. And you can get up to 100x leverage on select coins. Use my code and join GMX'er today. So with that, hello, CoinFlipCanada. How are you?
Doing really well, Mark. But by the way, I think for some of your listeners, if they're already on GMX'er, they can actually check out the GMX token. It's listed there.
Ah, very nice. Yeah, you had some other big listings this week too, right? Who else listed you?
We were listed by both FTX and Binance this week, along with a few others. Gate.io, Huobi, I think later this week. It's been quite a busy few days.
That's a big week. Yeah, congratulations on all that. Those are all the kingmakers. So whatever you're doing it right. So congratulations on all of that.
Well, we love and are always worried by the attention.
That's probably the proper response. So let's move on now to GMX. So I'm going to take a crack at describing what it is, and you can tell me whether I got it right or got it wrong, but I'm going to try to summarize it very quickly. So GMX is a decentralized 30x perpetual long or short trading site on a DEX. And it's kind of miraculous that you can do this on a DEX. That's kind of your key innovation. And at the moment, there's only 4 coins offered for perpetual 30x perpetual long or short trading. That's Bitcoin, Ethereum, Chainlink, Link, or Uni for Uniswap. But the plan is to offer a lot more in the future. So far so good.
So far, so good. Although I will just mention that we also have trading for the AVAX token on our Avalanche deployment, since we're both on Arbitrum and on Avalanche.
Ah, very nice, very nice. Okay, so really 5 coins. Just you have to go to a different chain to get the 5th coin, but you do have it. So very nice. And then just some quick stats. So you have 120,000 users to date. You've done $70 billion in volume. And the site says you have 140 million in open interest. And I don't know what that means. So what does that mean?
So 140 million of open interest means there's 140 million of open positions. That's long positions, short positions on the 4 or 5 tokens that you just mentioned.
Got it. Okay. So that's sort of, your TVL. Well, sort of TVL, I guess. That's how much money's in your system in positions. So
actually, that's slightly different. Interestingly, as you mentioned, we are effectively a DEX. And we're a DEX or an AMM DEX. So we actually have a little over 400 million of liquidity that's been put up by members of the DeFi community, institutions, and a whole range. And that's what underpins the ability for those that open interest. So open interest is actually the traders and what they're trading, and our TVL is actually the larger pool of funds available for people to trade against.
Got it. Thank you for that distinction. I understand. So let's get into how you do the leverage. By what sorcery does your DEX offer leverage trading with 0 slippage and 0 impermanent loss for those supplying liquidity?
Well, in many ways, we're the exact opposite of magic. We are sort of it's in many ways all the way back to what original trading was. If you have something, you can trade it. And that's sort of when I mentioned that we've got about a little over 400 million of TVL liquidity in our pool. That means that if you decide to open a Bitcoin long, we have Bitcoin there to settle it 1-to-1. Every single BTC, every single SAT. If you want to long ETH, likewise. If you'd like to short BTC, ETH, Link, Uni, AVAX, likewise, there are stable coins sitting in the pool to settle that position, even if, God forbid, every one of those tokens went to 0. So that's really how we're built. It's in many ways the exact opposite of degen. It's completely backed, secure trading, more akin to So it's really in many ways, as I said, the magic is that there is no magic. But what there is a set of very prudent mechanisms to make sure the liquidity providers are well protected through our Oracle pricing model. Traders receive, guaranteed no price impact, no slippage trades based on the current market price. So it's really been about creating a very fair marketplace for people to be able to, take directional positions, hedge, do whatever they may want to do, but be able to do it clearly on chain.
So what I want to get into though is so this is my understanding of how you do it, how the actual mechanisms work. So you have a pool that you call GLP. So that's I guess GMX liquidity provider, and it is a pool of 8 tokens: Ethereum, Bitcoin, Link, Uni, and then 4 stable coins: USDC, Tether, DAI, and Frax. And this pool is where the 400 million is in that services the leveraged positions. Correct so far?
Absolutely.
Okay. So the GLP, and this is what's new and new and different compared to sort of some other offerings like Uniswap, where everything is in one pool, and the weight of each one of these coins is different. So it's I'm looking at it right now. So you have 31% Ethereum, 28.8% Bitcoin, 2% Uni. So it's not quite even, but it's sort of it's not even, but it is sort of roughly distributed in the sense that it's not like 99% Ethereum. You try to sort of spread it out over all 8 coins, and basically anytime somebody shorts or longs the first 4 coins, this is the counterparty, and so the GLP pool collectively acts as the house. So because most people who use leverage lose on average, the house usually in this case wins. So the value of the GLP pool goes up in value if odds, if statistics play out the way they normally do. But it is possible if you get one or several whales who actually beat the house for GLP to lose and for GLP to go down. So it's not impossible to lose here. So if I characterize all this correctly so far?
Absolutely.
Okay. You want to add anything to that, or is it?
Well, I think the other piece though is fees, because I think one very important thing is that and I don't disagree with your statement, which is that most traders lose, and that's simply because leverage, if utilized, without prudence, will put you into difficult situations. Yeah. And I think that's something that we ensure that, as we said, there's a fair market, but in the end, the trade is yours. But even if traders were neutral, or even traders were making a bit of money, we would still say that it's actually a very profitable position to be a liquidity provider, because there's a lot of fees being generated. You're generating both open fees, closed fees, swap fees, borrow fees. All these fees are going in. And very importantly, as opposed to a lot of liquidity pools that most people in DeFi are used to, there's really no impairment loss. We don't sell away excess tokens for effectively below market value to achieve some sort of parity of assets. We do have target weights. We do gentle actions to sort of move in that direction. But in many ways, it's by making the structure a little bit more flexible, not being as rigid for what liquidity providers' exposure is. In many ways, you're actually able to keep a lot more value. For the same reason, you're forced to take suboptimal actions.
Yeah, so that's really so. Let's talk right now about the no impermanent loss idea. So the reason why there's no, so you said something, I think you've said 2 things that are contradictory, and I want to clear them up. So you said at first that this is an AMM, and you also said that there's no impermanent loss. But my understanding of how your mechanism works is normally with a regular AMM like Uniswap or SushiSwap, it is the price of a particular token is determined by the pools within that particular AMM. So as the pools fall out of whack, the pools change the price of the coins that are in that pool in order to bring itself back into balance. And it does so by relying on arbitrageurs to actually bring the pools back into balance. And that can cause impermanent loss. Whereas your system doesn't rely on arbitrageurs. Your pool uses oracles to set the price, and you actually have the real coins inside of your liquidity pool. So you're not doing the same thing. So that's why you don't have impermanent loss, and that's why you have zero slippage. Did I get that right, or is there more to it than that?
Well, so two pieces. In terms of why we wouldn't have impairment loss in the same way that, let's say, a typical AMM does, is absolutely correct. Because, as opposed to us needing to give that value away to arbitrageurs to sort of get price discovery and bring it back to the market price, utilizing, high-speed oracles, really from the best data sources, the biggest, most liquid markets for these tokens, we're able to only transact at the market price. And we don't need to then effectively either. If you think about it in many ways, if I were to take a pool like an ETH USDC pool, in reality, you're giving somebody away some of your ETH or some of your USDC in exchange for bringing it back to, in theory, the par value. And that comes at the cost of the liquidity provider, which, as you said, isn't captured here. On the other side, though, our pool does need to still generate volume, do a lot of other things to generate fees to obviously still be making money, and that's why we've created this model. The no price impact is slightly different. The reason for no price impact, and which over time maybe our model will continue to evolve, it was really about trying to create a singular model that addressed both concepts like bid-ask spread, slippage, fees, and really just put it out into one clear transactional number that you could say, here's the Oracle price, here's the fee, here's your final price, and it's done with clear transparency. I mean, in many ways, one of the biggest costs that people don't even realize is how much money you really lose sort of in the bid-ask on many tokens. And so, especially for these big liquid markets, we thought this was a far better approach to the model. But I will say that GMX has grown considerably larger than, when we started. And with that larger market position means that, we may have to make some modifications to our models. And we did recently release last week the code for our GMX Synths, which is sort of our I won't call it our 2.0, but it's an upgraded protocol that we're bringing out for lower liquidity tokens, and it does integrate a lot more features to help create these nice fluid on-chain markets.
Got it. Okay, so getting back to one of the other claims you guys make on your site, or I guess it might not have been you, it might have been an analyst, but basically the claim was there are no temporary wicks. There are no temporary wicks for liquidation. And I guess this goes back to the fact that you are not an AMM like Uniswap, where you have pools trying to bring themselves back into balance and relying on arbiters. Is there more to the no temporary wicks, or is that basically why? That makes sense? So,
no. So actually, the no temporary wicks is actually more a phenomenon from centralized exchanges. If you think about one of the big struggles that does happen with centralized exchanges, or really any environment where you're dealing with small pools of siloed liquidity, is you can reach a point where there's no more liquidity in that venue, and it has happened where the price on a singular exchange has sometimes moved dramatically out of step because of effectively liquidations. So with GMX, what you're getting pricing from oracles that are aggregating multiple venues. It means that you're not now prone to one trader who got liquidated or had a large market trigger order that's wiped them out and dramatically moves it off. You're kind of getting that aggregate of the market. And more importantly, while we use fast oracles, we also rely on Chainlink. And when it comes to actually doing a liquidation, we only liquidate if Chainlink, which is aggregating with dozens of data points, says the market price is down to a point that liquidates you. It's again our effort to make sure that you have transparent markets, and again, a lot of the things that we think about have to do with how do you deal with liquidity, how do you deal with fragmented liquidity, how do you help to make a market bootstrap even when your liquidity may be initially very low. So as we thought about a lot of these issues, we said how do we present to a trader, a user, an environment that they can see is inherently more fair. Open your trade, you may come out ahead, you may get liquidated, but if it happens, it will have been done in a very fair and transparent manner based on the broader market, not based on some quirk of our platform.
Got it. So a lot of these centralized exchanges and frankly DEXs as well, they have sort of a local price, right? So they're not really pulling from an oracle; they're pulling from their own internal data, and basically, if there's some price action because of liquidation inside of their little universe, that can hurt traders, even though the price didn't really drop in the broader market for any of these coins. It might have dropped within the centralized exchange or Uniswap or whatever. And so basically those temporary wicks are a result of that. And your universe relies on Oracle, so you're looking using Chainlink. You're looking at everything. You're looking at the entire broad market. Well, not everything, but most everything that's in Chainlink, right? So that's why. Did I summarize
Absolutely,
it correctly?
yeah.
Yeah. Okay.
Yes, correct. We're working with a wider set of data that I think gives you more reliable pricing.
Okay. So let's talk now about like what could break this. And in the post-Luna age, we're all thinking of like, okay, so how can this go so horribly wrong? Apologies in advance, but I think we all have to sort of think like this a little bit now. So in looking at your system, my guess is that if you have a large number of shorters in your system, and we have a Luna-like, cascading liquidation collapse in the broader market, so not in your universe, but just sort of at large, and you have a lot of shorts, that's basically going to suck a lot of collateral out of GLP. And, so if the entire market takes a huge nosedive and you have a lot of shorts, that could drain GLP and that could, break the bank, if you will, in your system. Is that correct or not?
Okay, so I'm only gonna correct the last part, which was break the bank, because to me, break the bank is when you have we use break the bank. It's when you've got more money than you on hand than you can settle, and that's one thing that GMX doesn't do. So you can't break the bank. And I think it's an important distinction, because in many ways, whereas we allow traders to leverage, we don't. Our side is really, maybe you could say even not being that capital efficient, because we keep everything back to one, but we've created an environment that's very high velocity, which is obviously capital efficient. But again, to your point, and we do worry about these issues. That yes, what happens if you have a lot of shorts open? And mind you, we do have caps on the amount of shorts that that can be open for individual tokens. But you could have your entire long side, which is 50% of the pool, going down in value against dollars, and you could have people having shorts, which means that even more exposure exists sort of on effectively being long as a pool. It is absolutely a risk. I will tell you a few mechanisms, only because you mentioned sort of UST as an example. We have a range of different mechanisms. Currently, some of them have to be sort of reset, and we're working on further automating them, which is, one is we have our target weights so that, over time, people can't swap and open positions and dramatically increase the amount of tokens that we would be absorbing. We have hard limits set, which again, over time get reset for the actual number of an individual token that we will even absorb within the pool. So if the price really starts dramatically dropping, it's not that we would be a buyer who would just keep accumulating those assets to no end. And so there are mechanisms that sort of really help to reduce that. But it's something that as we look forward to GMX Sense, we've started adding in mechanisms like negative and positive slippage, funding fees, including funding payouts, different mechanisms that will encourage, I would say, both retail and very large trading desks, and even potentially people who decide that they want to operate on-chain vaults, who are just looking for that counter trade opportunity, kind of similar to what GLP does today, to come in and pick up those opportunities so that as a market, we can try to stay as close to neutral in terms of exposure while trading a very fluid market, and giving other people an opportunity who want to take that exposure to take that exposure. Again, it sort of creates an opportunity to have different people provide liquidity who have a different sort of risk profiles and return expectations.
So in general, your system will not allow leverage positions to be created that go beyond what the GLP pool can handle in a worst case event.
Absolutely. That's the hard cap. But in reality, token by token, we actually tend to have caps that are lower than even that maximum, partially to ensure fluid functioning of swaps and other functionality within the platform.
Got it. Okay. So relatively safe.
Yep.
Okay. So let's talk now about staking. So you've basically got the GMX token and the GLP token, which is the pool token. So let's talk about GMX first of all. So GMX is the governance token, and 30% of the platform fees go to GMX stakers. And at the moment, that's making 15% APR, correct?
I haven't checked this week or this day, but yes, sounds about right.
Okay. And then the GLP token, which is the GMX pool liquidity provider token, that is making, so 70% of the platform fees go to the liquidity providers. So that's great. Some of the fees you mentioned earlier, like the transaction fees, the funding fees, all that stuff. And I don't know what the APR is on that just yet at the moment. But I do know that I interviewed Vesta a couple weeks ago, and they said basically if you take the GLP token and put it into their vault, they're giving you 120% APY, I think, on the GLP token, mostly through looping. So not bad.
Yeah, so I mean, there is definitely strategies like what Vesta are doing, and there's many other people who are sort of working on different models where GLP can be utilized as collateral, and that's those are some of the use cases. But yes, you're correct. So GMX is our governance token. You can stake it. You do earn a portion of platform fees. And then you also take responsibility for being part of governance, voting on adding tokens, removing tokens, changing the balances, and a few other activities there. And GLP, as you said, what's great is, not only is GLP, you mentioned the yield on GLP, but the fact that GLP is, as we mentioned, backed by that basket of 8 assets that we talked about, 4 stable coins, 4 volatile tokens, that's on the Arbitrum deployment. And whenever you want to redeem from GLP, you can just simply redeem for any of those tokens. So you're getting a real liquid yield paid out in ETH against this nice diversified basket of crypto assets, which you can exit at any time if you wish to.
Yeah, it's really caught the imagination of Twitter. I watch this stuff like a hawk, and I've rarely seen something, a concept sort of take crypto Twitter as quickly. I've seen other things, but not a lot. This is definitely one of the more popular ones, though, like GMX and GLP. So that's why at the beginning of the show I said it's it's the internet's new, Twitter, crypto Twitter's new darling, right? So congratulations, you've absolutely captured the imagination of crypto Twitter for sure. So you guys, tell me a little bit about the history. So were you guys on another chain before this, and how long have you been in existence?
Okay, so the GMX DAO was formed last year, and effectively the GMX DAO came up through, in some ways, I don't know if the right word is a merger or basically a voting from 2 different protocols that had a similar developer base. One called XFix, which was on Ethereum, which was a very early project, well, early in the DeFi space, sort of at the end of 2020, which.
Yeah.
But which worked on a lot of very interesting concepts around token value decay, token balance decay, rebasing, a lot of concepts that, actually is, in a funny way, carried on into the meme space subsequently. But it was really, the lead developer really was working on, which was X, was working on these concepts to just say, how can we sort of port some of these over? And as part of that was the rollout of a platform called X2, which was leveraged tokens, 1x, 3x, 10x leveraged tokens deployed on the Ethereum mainnet. But there turned out to be some real practical limitations. Fragmented liquidity. Every token needed its own liquidity, and if there wasn't enough liquidity, the pool would just be unattractive for anybody to enter the pool. Well, that's a bit of a problem. And gas fees were really quite a problem. And the community that was sort of had built up around XFix, a proposal was brought to them, which was, why not build something on chain that sort of starts to address these issues? And that's out of that came a bit of a process that sort of launched a second protocol called Gambit on BSC, which has many of the similar hallmarks of what GMX started with, but there were a number of other pieces of the puzzle that were just not entirely there yet. And while I would say that BNB chain has come a long way, not counting the issue they had last week with
there's that issue. Yeah.
But BNB chain or BSC then BNB chain now has come a long way. But at that time there was really the chain was bursting. It was almost at a breaking point where, as a protocol which really relied on the chain being live, active, and sort of functional, it was becoming harder and harder to maintain. And I think that's kind of when the vote was taken to sort of have these protocols merge, come under a new umbrella, and sort of launch on as GMX on Arbitrum. And that was both allowed a lot of the learnings from what had been done to be applied, look at the opportunities with a chain that was constructed, how we could work better in these public blockchains, and sort of roll forward. And so, I guess, from where we're sitting right now, it's been almost 2 years since the very first protocol, that was involved in the platform launched and everything that's gone through. And it's gone through many iterations. And so, I mean, I kind of use that example that you said. It's amazing how much work goes into becoming an overnight sensation. Like it's, but it's amazing how much, and it's cliche, but I know it gets said all the time in crypto, but if you followed our backstory, every one of these ideas came from the community. It has actually been so community driven in terms of what the improvement should be, what should the direction be. And it's kind of great because it's that Web3 experience where you have a direct line to both your traders, your liquidity providers. Everybody is right there giving that feedback, which helps you to create a better product.
Yeah, it makes a lot of sense. Okay, interesting. So 2-year history. This is sort of, I guess, the third iteration of it. Probably more than that if you probably count all the little steps in there. I actually read a version of your white paper, and I believe it was for GMX, but you had yet not arrived at the GLP token. You had another token that was sort of like an intermediate representational token. You didn't call it GLP. You called it something else.
I think USDG.
What's that?
Was it USDG?
Don't recall. That doesn't sound right, though. But yeah, there was another version of this I read, and it was pretty interesting because it looks like it's the version right before the current version that was the one with the secret sauce and the GLP token. So it's pretty interesting to read that. Off the top of my head there. Okay, so you're currently. So tell me, why did you go on to Arbitrum? Why Arbitrum specifically?
So. In many ways, and this was, I'll say this, we, as sort of that whole vote came together, 2 new communities, one from BSC, one from Ethereum, and they sort of are deciding the course. The focus really did move very much so to, in Ethereum L2. It felt like a natural home that sort of unified that experience. It was both something that drew security from Ethereum, but enjoyed that low-cost, high-speed, low-latency environment that BSC had started, but was not all the way there.
Got it.
There was a lot of time spent looking at, and this is taking nothing away from any of the other platforms, but obviously at that stage, I would say there was sort of 3 L2 or L2-ish platforms between Polygon, Arbitrum, and Optimism.
Yep.
And to a great extent, it sounds really weird. I think we did a lot of internal dialogue, and I think we found that there was a real support within the, let's say, the OG Ethereum community with regards to the direction and the approach that Arbitrum was taking. Arbitrum, opened on an entirely, permissionless basis. There wasn't a restrictive list of protocols that could deploy there and then test there and do that. It was opened up in a wide open fashion. There were obviously certain limitations and throttling and things that they needed to do as they were bringing in L2 up to speed. but at least with clear roadmaps as to how they would fully decentralize that control. And so there was a lot about the ethos that made us feel very comfortable. And performance-wise, the chain had all the potential to deliver what the trading experience we needed, and it has delivered that. Especially after the Nitro update that was done a few months ago, where you've got extremely consistent low gas fees, all still backed and bundled, onto the Ethereum mainnet. It's an environment that has been very fruitful that way. I think the other piece, which we didn't realize when we took the decision, but has really been a blessing, is that because there was at least at that stage no talk of a token or anything else. It really just became this wonderful community of DeFi builders. I mean, it's not just GMX. There's so many other protocols over there. You've got protocols like DopeX and Jones DAO and Treasure DAO and Umami and Vesta, and Plutus, and so some have come more recently. Some had been there at the beginning, especially the ones who were there at the beginning. It was really a focus, and you definitely got that very small, village feel where we could work with other people, communicate, build. We were building out what we were building; they were building out, and it felt very collaborative. As I said, we didn't know that when we went in, but it definitely turned out to be one of those things, that you really appreciate.
Got it. And on that note, I noticed that you guys listed, you said you have a partnership with Olympus now, and we just had the Olympus guys on here 2 weeks ago. So tell me a little bit about that partnership. What can you tell me about that?
Yeah. So, Olympus DAO has had a product called Olympus Pro, which I believe they're spinning out or turning into a new protocol entirely. But which was, I think, a great example of a product that fit the market's requirements. I mean, sometimes it's not the most complicated thing, but it was, the Olympus Pro product is something that we found very useful for how we decided to work with our, sort of bootstrapping up, not our liquidity, but our ongoing development funds, marketing funds, and the like. As opposed to most protocols that sort of, they have private sale investors, they build up a treasury, they go build privately, and then they eventually launch the protocol. We had a very small team, group of contributors, built the entire protocol, launched the protocol, and then based on the success of the protocol, have been filling a treasury to create a runway for ongoing development. And partnering with Olympus DAO with our Olympus Pro product allowed us to run our small monthly community sales, where we just sort of keep accumulating, the product treasury. That's the one formal arrangement that's already there. There's a lot of other conversations that we're having with the Olympus team, and we're really big fans of theirs. We're definitely seeing if there's ways that we can create markets for them on GMX Synths going forward. We definitely see that Geom is a great asset. We're quite excited by their plans to go multi-chain now natively with things like Geom and the like, where I think they can definitely start to become a very interesting collateral within DeFi, especially as there are certain censorship concerns around USDC and various other tokens. I think it's quite interesting times.
Yeah, Geom, that is the one thing that's pretty interesting. So a lot of people think or thought that Olympus DAO was just dead, right? So that was sort of, including me for a little period of time, until a friend of mine pointed out that they still have almost 300 million in their treasury, which is what backs Geom, which was what makes it such a powerful asset to own, right?
Absolutely. I mean, if you think about it, to be fair, obviously the eventual goal was to be a reserve currency, but the whole 3x3 and all of that, the entire API thing, was a bootstrapping mechanism to build a treasury. And now, I'm excited to see, what they do by being able to deploy that. We kind of ended up in the other direction. We started with nothing, and we've now sort of just, everything is sort of in the hands of our token holders. The value for us is the protocol.
So, question about the GLP, your treasury. Do you simply hold it, or do you actually try to farm that for yield?
So the underlying tokens, as on date, are purely held. we obviously there is a certain value for being able to extract, let's say, an underlying yield from some of those assets, and that's something that we're definitely looking at if we can do safely and in a safe manner. I'll give an example. Staked ETH was obviously definitely an asset that we would have considered and we were considering, although we had some technical limitations at that stage, which weren't going to allow us to do it, including them not being on Arbitrum until now. They've actually just recently launched on Arbitrum. But the deep peg, for example, that happened with staked ETH a few months ago is definitely something that says, don't assume that yield is risk-free. There is always going to be risk. There is risk with GLP as well. And as we look at taking some amount of the underlying assets to achieve some additional yield, we'll try to do it in a way that is, I'd say, risk adjusted. It makes sense. And so I think staked versions or staked versions of certain tokens being as a part of our liquidity pool is definitely something that could make sense.
Got it. Okay, well, we're getting close to the 40-minute mark here, and I usually try to keep the show around that. So, what's next? What's coming up next for GMX? When will we see more than 4 coins? Give me a little bit of a picture of what the future looks like.
Yeah, so GMX since went out to our auditors last week, and I think there's a part of our community who's actually super excited, but that news kind of got drowned out by Binance and FTX listings and all these things that the market pays a bit more attention to. But for us, it's a very large milestone because for us, there's a lot of improvements in the protocol. We definitely feel that our target is that by the end of this calendar year, so the end of the quarter, we're going to try to release that in a limited beta on chain. Maybe let's say with some liquidity caps, and just to allow it to be sort of tested and make sure that in a production environment it's running well. And then looking to have that deployed, at some point early next year, and really try to move over a portion of our liquidity over there, allowing liquidity providers to have a bit more granular control on which markets they want to support liquidity under. So there's still going to end up being a product that is similar to GLP that sort of brings you the basket if the basket is what you prefer, but then also give you the opportunity to support specific markets. Which also can be very useful for individual protocols who may want to just be able to support markets. So, we were just talking about Olympus. If Olympus wants to be able to support trading for their own token in that sort of environment, there could be members of their community, they themselves, who can just say, you know what, this is a better way for us to direct our liquidity and our exposure, as opposed to wanting to be in a basket where it's only a few percent. So both of those options will be available. We've also had a lot of discussion with multiple blockchains who've all been approaching us for GMX to sort of expand out and sort of be, another building block within their DeFi, environments, having seen what we've done on Arbitrum and Avalanche. So I think that's the other piece that will happen over the next, I would say, 2 months, is really, I think a real intense conversation within our governance as to, do we expand to another chain? And if we do, which chain? And how can those chains help support our growth, and how can we help support and really be as I said, sort of a cornerstone for their growth as well. And I think those are two. There's a few more things that I can't really say because we're just sort of sorting out the contracts and stuff. But I think you're going to definitely see a real big focus on us trying to help to stimulate our engagement within the ecosystems. That's with other protocols, and really just trying to get day-to-day traders using GMX more. We're still a protocol that's probably known by more, DeFi, degens, hardcore users. We'd really like to make sure that, a more retail, but, DeFi user starts to become aware of GMX. And obviously, I think the last few weeks or months, as you mentioned, Twitter has definitely been much more active. And as a reference, that's entirely organic. We have never paid a single person a single penny to go and promote GMX.
That's great. Good job.
And that is, I think that a lot of that credit goes to, as I said, our community. they know that we won't. They're the ones who then go and they push and they evangelize and they send the message out, because I think they really feel vested in how much they've helped the protocol to grow and what they're contributing to its
Totally
growth.
great. So we're up at the end of our time together. So where can people find you and your stuff online?
If you go to our information site, gmx.io, you'll be able to get information on both the token, our entire ecosystem, our NFT project, and also links out to the actual trading platform.
Got it. Well, thank you so much, CoinFlipCanada. I really appreciate you coming on the show. My name is Mark Jeffrey. This has been Hash Rate. We'll see you all next time.